Hello, and thank you for joining us today. I'm Marisa Coggin. I am a partner in the insurance group and co-lead of the corporate group in Toronto. My practice focuses on corporate and commercial law with an emphasis on insurance regulatory matters. So today I am joined by two of my colleagues in the insurance group, Tashina Ashmead, whose practice focuses on insurance regulatory and corporate commercial matters, and Jesse Collins Swartz, whose practice focuses on M&A and insurance regulatory matters. And last but not least, we're also joined by Jamie Carty from our privacy and cybersecurity team. Jamie's practice focuses on privacy, data governance, and regulatory compliance. So what better time to talk about the regulation of motor vehicle protection than road trip season? If we could just skip ahead one more slide, please. So just to set some context for today's presentation on motor vehicle products and vehicle warranty, there's a wide variety of protection and warranty products in the market today, both in the consumer vehicle space and the commercial trucking space. The scope of coverage that is offered under these products only continues to increase as we see advancements in technology. And as a customer, you can buy everything from tire and wheel plans that can help you pay for any damage to rims or tires from hitting a curb, let's say, or you can purchase true mechanical breakdown coverage or anti-theft products that are intended to reduce the incidence of auto theft. In addition to the wide variety of products, we're also seeing continued innovation in the distribution of insurance, as well as with other consumer-related products. So that continued change and innovation, as well as the wide variety of products available in the market, contributes to the need for clarity as to how these products are required to be distributed and marketed. Next slide, please. So what does all this have to do with insurance? So to take a step back, in Canada, vehicle warranty and vehicle protection products are not regulated uniformly across the country. Certain provinces have actively regulated these products for some time, including BC and Alberta, which is what we will be focusing on today, while other provinces do not currently regulate these products as insurance. As a general rule, protection and warranty products for vehicles that are underwritten by a third party do tend to be viewed as insurance. And when I refer to a third party, I'm referring to a person that is neither the manufacturer nor the retailer or dealer of a vehicle. And the theory here, from the regulator's perspective at least, is that a third party just doesn't have the same nexus with the customer. They don't have a contractual relationship usually with the customer or any other relationship that makes it likely that they wouldn't default on their obligations. So because of that, the indemnification from the regulator's view of certain perils related to the vehicle makes that product fall into the bucket of insurance. So BC and Alberta have specific classes for vehicle warranty and equipment warranty insurance. If there's one thing you take away from this presentation, it's that these classes are not a catch-all for all vehicle protection products, as we'll discuss later in the presentation, but they do relate to mechanical failure or breakdown of the vehicle. Next slide, please. So I get asked this question fairly often in the vehicle space because there are plenty of gray area products in the market, and the definition of insurance is actually quite broad. And insurance regulators are given a lot of discretion as to how they interpret that definition. So whether a product constitutes insurance is going to depend on a number of factors. We've already talked about the obligor and the identity of the obligor, whether they are the manufacturer, the dealer, or someone else, i.e. a third party who doesn't have a relationship or nexus to the customer or to the underlying product. But what we haven't talked about yet is what are the terms of coverage? Are you agreeing to, as the obligor, repair or replace part or all of the vehicle? What is the nature of the thing that has to happen to trigger that repair or replacement? Is there something that needs to trigger it, or is it something that the customer can access at any time? Or are you paying them an amount, a cash amount, or is it a credit instead of it being a repair or replacement service? Lastly, what I didn't put on this slide actually is we always do have to consider how it's being distributed. Is it incidental or part of the same transaction as the sale or lease of the underlying vehicle? Or is it something that can be purchased aftermarket? Next slide, please. So jumping into BC, the BC FSA released a regulatory statement last April, which actually resulted in their prior guidance on this same topic from being rescinded. There's a legislative exemption in BC, which permits manufacturers and dealers to underwrite and distribute their own vehicle warranty insurance if certain criteria are met. So primarily, this includes the fact that the vehicle warranty plan needs to be incidental to the sale of the vehicle. So you cannot, as a dealer, distribute a vehicle warranty plan aftermarket and rely on this exemption, because that wouldn't be considered incidental. And it also needs to be limited to mechanical breakdown or to towing fees or car rentals or accommodation that arise out of that mechanical breakdown of the vehicle. So including other protection products or benefits that are not within that scope take you outside of the exemption. And the consequence of that is that they are no longer considered vehicle warranty insurance, and therefore they need to be distributed and underwritten as automobile insurance. And this becomes a little bit challenging, and I'll explain that in the next few slides as to why it becomes challenging. But just keep in mind for now that there are no exemptions in the legislation in BC for appearance protection products for vehicles. So that's windshield repair and replacement, dent and ding, tire and wheel, key and fob replacement. And there are no exemptions for dealership loyalty products, which I'll also talk about in the next slide, please. So dealership loyalty products are generally sold by the dealer at the time or sale or lease of a vehicle, and they essentially promise the customer that they will have a predetermined discount on the purchase price of a replacement vehicle should anything happen to that current vehicle that they are being sold at point of sale. Usually this relates to theft, loss, or another external peril. So because of the presence of that predetermined benefit and the fact that it's tied to an external peril, that in the BCFSA's perspective is generally sufficient to bring it into the definition of insurance. Next slide, please. So how do you develop a compliant distribution plan for all these products? Number one, it really depends on what type of product you have. Are you talking about a vehicle warranty product? Are you wanting to sell appearance protection for vehicles, dealership loyalty programs, or is it a mix of all of those? Keeping that in mind is going to be really important in terms of how you structure the distribution scheme. You may need to include a fully licensed general insurance broker or agent in BC to ensure that any licensed activities, and that includes solicitation, it includes placement, negotiation of the insurance, renewals, ensuring that those are fulfilled by a licensed person. And that's all on the caveat that you can't rely on the vehicle warranty exemption. If you can rely on that, then the dealer can underwrite and sell that product. And again, we have to keep in mind the incidental sale rules. BC dealers or auto dealers generally will not have insurance agent licensing, and it is actually fairly rare for them to have restricted licensing because that class of licensing used to be available, but hasn't been issued in terms of new licenses in the past 2 to 3, maybe even 4 years, if I remember correctly. So that becomes a little bit tricky on the front end of the distribution plan to figure that out without having somebody licensed in the chain. Claims adjudication also needs to be considered when you're evaluating the customer journey for compliance. Next slide, please. So moving into Alberta, the Alberta Superintendent released a bulletin in December of 2024, which is actually very comprehensive and addresses a number of commonly sold products in Alberta. In terms of third-party vehicle warranty contracts, including dealer warranties, those are generally regulated as insurance in Alberta. So if a manufacturer or the manufacturer's subsidiary is offering a warranty on the vehicle, i.e. related to inherent defect, it's not insurance. But anything that goes beyond that, so covering risks or perils that are beyond inherent defect, even if you are the manufacturer as the obligor, that does become insurance. There are obviously exceptions to this, but that is the general rule. And similar to BC, most of the appearance protection products that are available for automobiles and the dealership loyalty products that we talked about for BC as well, those are considered insurance. They are a mix depending on what is being covered of automobile insurance and property insurance. So that's also important to keep in mind when you structure your program. roadside service plans, service contracts for planned and routine maintenance, things that can really be accessed by the customer at any time. They're not related to road hazard or another peril. Those are not insurance, and the superintendent helpfully, I think, pointed that out in the bulletin. Next slide, please. So I'm actually going to skip ahead one more slide, but I did include a list of examples just for reference. Thank you. So for the licensing considerations in Alberta, where a vehicle warranty or protection product constitutes insurance generally needs to be underwritten by a licensed insurer. As a starting point, any solicitation or distribution of the insurance product needs to be done by a licensed agent. However, one difference between BC and Alberta that is helpful, I think, is that automobile dealers in Alberta may actually have restricted licensing to sell a lot of these products because the AIC, or Alberta Insurance Council, is actively making those available. So there are restricted licenses available for equipment warranty, ancillary vehicle protection products, as well as motor vehicle dealership loyalty products, which really helps facilitate these programs. And as well, we need to be mindful of claims. How are those being adjudicated? Is it going to be done by a licensed adjuster that's a third party? Is it going to be done by the insurer or an affiliate of the insurer? Or is it going to be done by another person who benefits from an exemption under the legislation? Next slide, please. So in terms of trends and enforcement, the regulators in BC and Alberta continue, I would say, to be fairly active from both an investigation and enforcement perspective. The consequences of noncompliance will really vary depending on the nature of the noncompliance, as well as whether there are any mitigating factors. There's a whole list of mitigating factors, but the ones that we find make the biggest difference are whether there's a history of noncompliance and whether the entity ceased distribution of any unauthorized products if they were ordered to do so. Obviously, consumer harm is also relevant. On a positive note, more and more jurisdictions across Canada are implementing restricted licensing regimes, both in the vehicle space and in other customer product-related spaces, which really enables non-insurance entities like motor vehicle dealerships and other types of distributors to sell limited types of insurance products, which complement their overall offering, but I think also facilitate the insurance coverage process and tend to close the gap in terms of protection for these products and for vehicles, which are expensive. So that is an important component. Next slide, please. So to close this out, I will give you my 5 top pointers on this area. So first of all, I like to review the entire customer journey from start to finish, including the proposed flow of funds. I think it's very difficult to ensure that that something is being distributed correctly and in compliance with laws when you don't have a full picture of exactly who's doing which activities at every point in the chain. So this includes ensuring that unlicensed entities are not engaging in any unauthorized activity. It's looking at payments to intermediaries and dealers. These can include commissions, but also referral fees and other payments that are similar, and making sure that those are being paid and received in compliance with applicable laws and regulations. Program administration and distribution agreements should be reviewed. The policies or service contracts, depending on how they're structured, that are going to be customer facing need to be reviewed as well, in addition to the marketing materials and also the training materials that are going to be given to the dealers, depending on what their involvement is, as well as the controls that are set up so that you can ensure that the program is compliant and that there are like audits, reporting, all that sort of thing. In addition to reviewing the activities, you also need to ensure that the applicable intermediaries and carriers hold all the correct licensing to distribute, underwrite, and adjust claims. And lastly, I would always say that it's very important to involve legal counsel in any discussions with the regulators, particularly where they relate to voluntary compliance agreements or where there is a need to manage regulatory inquiries or investigations. So with that, I will turn it over to Jesse for his presentation.
Thanks, Marisa. So as Marisa mentioned, my name is Jesse Collins-Swartz, and I'm a senior associate in Denton's Corporate and Regulatory Insurance Group based in Toronto. You can move on to the next slide. So today I'm going to provide a high-level overview of the Automobile Insurance Rating and Underwriting Controls and Sound Practices Guideline that was published by the Alberta Superintendent of Insurance in January 2025. And for ease of reference, I'm just going to refer to this publication as the guideline. But before jumping into the guideline, I just wanted to provide a high-level overview of how automobile insurance is regulated in Alberta. So the regulatory bodies in Alberta overseeing insurers' conduct of automobile insurance business are the Alberta Superintendent of Insurance and the Alberta Automobile Insurance Rate Board. And just by way of additional background, any applicable automobile rate filings in Alberta would be submitted to the Alberta Automobile Insurance Rate Board. And insurance intermediaries, so brokerages, agencies, MGAs, and adjusters that are distributing policies of automobile insurance or adjusting claims in Alberta, they're regulated by the Alberta Insurance Council. And like many other jurisdictions in Canada, Alberta has form and rate filing requirements for insurers conducting automobile insurance business in the province. And so in particular, insurers are required who are writing automobile cover to write the cover on policy forms and endorsements that have been approved by the Alberta Superintendent of Insurance. And insurers can use their own bespoke policy forms. However, they would generally need to obtain prior regulatory approval before using them. And then insurers that are conducting automobile insurance business in Alberta must also file their respective rating programs with the Alberta Automobile Insurance Rate Board. I acknowledge there are certain exemptions, though, for fleet cover. Lastly, I wanted to highlight that there is a cap on the amount that insurers can increase automobile insurance rates for quote unquote good drivers in Alberta. There is a specific definition for what is considered a good driver. And this cap is set at 7.5% for 2025. Next slide, please. So as I previously noted, I'm going to provide a high-level overview of the Automobile Insurance Rating and Underwriting Controls and Sound Practices Guideline that was published by the Alberta Superintendent of Insurance in January 2025. The guideline applies to all insurers licensed to conduct automobile insurance business in Alberta. And the intent of the guideline is to provide sound practices for insurers' operations, controls, and governance with respect to automobile insurance rating activities in Alberta. The Alberta Superintendent of Insurance encourages insurers writing auto business in Alberta to incorporate the best practices set out in the guideline into their own automobile insurance underwriting and rating practices. Next slide, please. So the Canadian Council of Insurance Regulators Fair Treatment of Customers guidance forms the basis for the contents of the guideline. And when releasing the guideline, the Alberta Superintendent of Insurance reminded insurers the FTC guidance sets out expectations that insurers have mechanisms and controls in place to identify any departure from their respective organizational strategies, policies, and procedures that may result in unfavorable outcomes for the customer. And the guideline states that insurers are expected to have clear, well-documented, actionable, and measurable policies and procedures to mitigate risks relating to operations, controls, and governance for automobile insurance rating. And in particular, such policies and procedures must include robust processes to prevent errors and to quickly identify, assess, correct, communicate, and reimburse customers when such errors do occur. Next slide, please. So now I'll get into the 4 categories of sound practices for insurers to consider for the purposes of rating and underwriting automobile insurance cover in Alberta. And this is what's set out in the guideline. So firstly, there should be timely risk and error identification by insurers through conducting regular audits. It's important to point out that the Alberta Superintendent of Insurance acknowledges that many rating errors are actually identified within the insurer's own internal audit and governance processes. Also establishing a dedicated review team to regularly review and update governance processes and to stay up to date on any applicable regulatory changes. Insurers should also be conducting detailed reviews of new premium-related anomalies reported by customers or the insurer's distribution partners. Insurers should also be using actuarial and analytic software to review data and identify proven discrepancies. And lastly, there should be post-implementation checks for automobile insurance rate and product changes. The second category of sound practices relate to ensuring that consistent assessments with respect to incidents of overcharging are actually implemented. And in particular, if it's discovered that overcharging of insureds has occurred with respect to auto insurance, then prompt assessments should be undertaken to identify the root cause and the scope of the error or the errors. The third item is that insurers must prioritize and mitigate errors and emissions, and this should be done by developing clear action plans, including timelines for remediation of any applicable issues, implementing applicable remedial measures, and adjusting their internal governance practices and procedures accordingly. Lastly, insurers should implement ongoing risk monitoring and reporting to ensure continued oversight over automobile insurance risk rating. And so this includes incorporating items such as implementing policies and procedures where automobile underwriting and rating activities undergo multiple levels of internal review, maintaining written records of all automobile rating and underwriting errors. And it's important to note that this includes how such errors were addressed by the insurer, having clear processes for reporting and escalating risks and errors related to automobile insurance rating and underwriting, conducting regular audits, and also ensuring that best practices are shared amongst teams internally so that insurers can continuously improve their own processes and procedures. Next slide, please. So the next couple slides contain certain highlights in terms of how Dentons Canada can assist you with automobile insurance related regulatory and compliance matters. And this is a non-exhaustive list of just items that we regularly assist clients with in this space. And so this includes navigating provincial and territorial automobile insurance regulatory form and filing requirements. So what forms need to be filed, what rate plans need to be filed, what statistical filings are required, as well as underwriting filings. Federal and provincial insurer licensing matters, and this includes adding the class of automobile insurance both at the federal level as well as the provincial and territorial license level. The regulatory treatment and exemptions related to the distribution of fleet insurance. Review of automobile insurance policy forms for regulatory compliance, ensuring that the required terms and conditions are contained therein. Next slide, please. Also, the distribution and marketing of automobile insurance. This includes licensing of insurance intermediaries and insurers, as well as advising on advertising activities and online quote aggregation. Assisting with the structuring of claims adjustment. This includes both adjuster licensing as well as assisting with the drafting of service agreements with third-party claims adjustment companies. The regulatory treatment of emerging automobile insurance products, for example, technology-enabled usage-based insurance. And lastly, regulatory and market conduct investigations by insurance regulatory authorities. So I'll finish off by just saying we're always available to answer any questions that you may have regarding Canadian automobile insurance regulatory and compliance matters or insurance regulatory and compliance matters more generally. Thank you for your time, and I'll now pass things over to my colleague, Tashina.
Good afternoon, everyone. My name is Tashina Ashmead, Senior Associate in the Corporate and Regulatory Insurance Group at Dentons. And this afternoon, I'll be discussing the proposed FSRA rule for life and health insurance managing general agents. So to jump right in, FSRA released a life and health insurance sector review report back in 2021. And the report highlighted that the dominant distribution model among the insurers that FSRA reviewed was through independent agents placing business through MGAs. This observation underscores just how central the MGA channel has become in Ontario's life and health insurance landscape, raising important questions around oversight, accountability, and how insurers manage conduct risk across extended distribution chains. So this rule applies to managing general agencies that carry out what's defined as MGA licensed activities. That includes functions like contracting with agents, onboarding and screening them, training, and supervising agents on behalf of an insurer. If an MGA performs any of these functions, the rule applies whether the MGA is properly licensed or not. The rule also applies to insurers that are licensed for the class of life insurance in Ontario, and I'll speak a bit later about the important role that insurers play under this rule. Finally, it applies to individual insurance agents who are associated with those MGAs and insurers to sell or solicit L&H products. So following the 2021 findings and a rise in agent misconduct cases, FSRA introduced this rule as part of a 6-point action plan to tackle the concerning conduct and to close regulatory gaps in the life and health insurance sector. At the core of this rule are the five following themes and expectations. The first, licensing, governance and controls, supervision of agents, product suitability, and documentation and reporting. Next slide, please. Okay, so let's start with licensing. There's a separate licensing class specifically for life and health MGAs operating in Ontario. It formalizes the role of MGAs and places them directly under FSRA's regulatory lens, not just as a contracting party, but as a regulated distribution intermediary. And one key requirement under this licensing framework is the appointment of a designated compliance representative, or DCR as I'll refer to this individual. This individual must be an officer or partner of the MGA and must have the education and experience necessary to oversee compliance within the organization. Another licensing requirement relates to insurance coverage. MGAs must maintain general liability insurance, and they must also have either a surety bond to protect the insurer or E&O insurance. Next is governance and controls. MGAs must demonstrate they have robust internal controls in place, including compliance frameworks, escalation protocols, and risk oversight procedures. A key part of that control environment is oversight of both agents and sub-MGAs. MGAs must screen and monitor agents, assess sub-MGAs for their financial condition, competence of senior management, adequacy of independent compliance systems, compliance of their agents with applicable laws. MGAs must also report non-compliance by agents or sub-MGAs to FSRA and the insurers that they support, and conduct formal assessments of each sub-MGA at least once per year. The rule also provides that the MGA's compliance system should reflect its own size, complexity, operations, and risk profile. So there's no one-size-fits-all approach under this framework. Controls must be appropriate to the structure and the scale of the MGA's business. Additionally, MGAs must implement a client service continuity plan. This ensures uninterrupted service to consumers in the event that an agent or a sub-MGA can no longer operate. So the third area is supervision of agents. MGAs are expected to go well beyond contractual agreements and arrangements. They must actively screen for suitability, monitor and assess the agents that they decide to bring into their distribution network. An oversight or screening framework should include an assessment of agents by their risk profile, tracking of complaints, disciplinary flags such as a history of misconduct, non-compliance, regulatory issues, poor sales practices, verifying agent regulatory compliance, having defined protocols that keep records of onboarding checks, rationales for approval, and any conditions imposed. The rule also introduces specific expectations for recruitment. MGAs must ensure that conflicts of interest are managed and that no agent begins work until they're licensed, trained, and authorized by the insurer. Next slide, please. Now on to product suitability. MGAs are expected to support product suitability by helping ensure that agents recommend only what's in the client's best interest. While MGAs don't typically provide advice directly, they are still expected to play a key role in fostering a compliant sales environment, one where agents can provide accurate, non-misleading information during the solicitation, negotiation, and advisory stages of the insurance process. Again, that means ensuring that agents have proper product knowledge, helping to ensure that products sold are suitable, and making sure that agents aren't indirectly encouraging poor recommendations, for example, through sales incentives or compensation structures. MGAs need to maintain and support a system that promotes suitability overall. That includes training, compliance support, and perhaps identifying patterns that might suggest inappropriate sales practices. And finally, documentation and reporting. MGAs are required to maintain records to demonstrate how they're meeting the expectations under the rule. That includes records of agent screening, contracts, training logs, audits, complaints management, and any other supervisory actions that are undertaken. The rule also provides for the sharing of information and evidence between MGAs, some MGAs, and insurers, which demonstrates that everybody involved in the distribution chain is meeting their obligations. Next slide, please. Now let's turn to the role of insurers in an MGA-based distribution model. FSRA has indicated that insurers and MGAs each have independent legal and regulatory obligations. Working together is encouraged, particularly to avoid duplication of efforts, but that collaboration doesn't reduce or transfer ultimate responsibility. Even if agent screening or monitoring is delegated to an MGA, the insurer remains fully responsible for compliance with the Insurance Act and FSRA guidance. In fact, insurers are specifically required to screen and assess agents for MGAs for suitability, monitor conduct and take action when needed, report issues to FSRA, and also ensure continuity plans are in place if an agent or an MGA becomes unable to serve clients. So if relying on an MGA to perform certain functions like onboarding, agent training, the insurer must verify the MGA's capabilities, their experience, looking at their controls in place, and documentation to support their ability to take on those functions. So the bottom line is insurers can delegate tasks, but not accountability. That means having strong agreements, oversight processes, and regular performance reviews. Next slide, please. So to prepare for the new rule, what can MGAs do? MGAs can start by strengthening agent onboarding and contracts, update your screening processes, and ensure contracts cover items like compliance, suitability, and reporting. Formalize and document or update your oversight framework, including clear escalation protocols and assigned accountabilities. Review your current supervision processes to ensure it's consistent and well documented. Also consider implementing a risk-based oversight model by organizing agents and sub-MGAs based on key risk factors, such as sales volumes, product complexity, complaints, disciplinary history, and then tailoring your monitoring accordingly. Next slide, please. Training. Provide targeted training for your compliance, distribution, and onboarding teams so everyone understands their role under the rule. And embed accountability in daily operations. Finally, conduct those readiness assessments or gap analysis to identify where you may fall short of the rule's expectations, and then prioritize remediation efforts with clear timelines and owners. Next slide, please. Enforce date. So as it stands, the effective date of the new rule has not yet been confirmed following the close of the consultation period. So now is the time to prepare, even though guidance on timing and implementation is still forthcoming. The P&C industry. So this rule marks the first time that an Ontario regulator has issued a dedicated rule for MGAs in the life and health space. So it begs the question, what are the potential implications of the rule for P&C MGAs? My thoughts, perhaps a regulatory shift towards distribution oversight. The rule underscores FSRA's increased focus on the distribution layer, not just insurers. In P&C, this could prompt regulators to look more closely at MGAs that hold delegated underwriting authority, especially around governance, consumer outcomes, and agent supervision. It also sets a precedent for a formal licensing framework, which may raise questions about whether similar regulation is needed in P&C, especially again for those MGAs with broad authority. Influence on suitability and fair treatment standards. The rule ties MGAs to consumer protection and product suitability, even if they don't advise clients directly. In P&C, while MGAs often focus on distribution and underwriting, the concept of fair treatment of customers could extend through delegated sales. Documentation and accountability expectations. Life and health MGAs are now expected to document compliance, oversight, and their risk management practices. This may signal rising expectations for P&C MGAs to formalize their controls and their reporting, again, especially those MGAs with underwriting authority. And finally, increased scrutiny of agent platforms. Concerns about agent platforms without supervision may carry over into the P&C sector, particularly in relation to aggregators or digital network applications that interface with brokers and agents but lack robust oversight processes. FSRA's new rule marks a pivotal shift, bringing MGAs firmly into the regulatory spotlight and setting the tone for more accountable, transparent, and consumer-focused distribution in Ontario. So if you're navigating this rule and what it means for your organization, whether it's reviewing frameworks, updating contracts, or strengthening internal processes, we're here and we're happy to support. Feel free to reach out anytime. With that, I'll now turn it over to my colleagues Marisa and Jamie to take us through the next section.
Thanks very much, Tashina. So I'm back, but only for a few slides, don't worry. Jamie and I will be taking you through REBO's guidance on responsible artificial intelligence or AI use. So next slide, please. This really emanated out of REBO's observation that more and more Ontario brokers are beginning to adopt and expand their use of AI. There are obviously many benefits to AI adoption, but like all new tools, there are going to be potential risks that we need to be mindful of when incorporating AI into business processes and functions, particularly as they get more into the customer engagement type of functionality. Most of the AI tools that brokers will likely use will be third-party applications rather than being developed in-house. So because of that, there's inherently going to be an element of third-party risk that needs to be addressed and mitigated on an ongoing basis. AI tools can certainly help brokers meet their duties and expectations of customers. However, brokers do need to ensure that they're reviewing any AI-generated documents, information, or any marketing messages. And this isn't an AI-specific comment, but the focus really needs to be on providing the customer with the highest level of service and ensuring all information provided to the customer or to the public, for that matter, is clear, complete, and accurate. Next slide, please. So just to provide an overview of REBO's regulatory framework, because I think we need to think about that and have that in mind when we're talking about what responsible AI use might look like now and in the future. We have to consider the context for the guidance. So there are multiple sources of laws and regulations that are applicable to REBO brokers and to licensees. They are subject to many laws and regulations, but specifically they're governed by the REBO Act, the REBO regulations, the Code of Conduct, and all the REBO guidance that is published from time to time. And at the heart of all this regulation and guidance is really the objective of ensuring that brokers are acting in the best interest of their clients. So with that in mind, we'll talk about some of the key principles in the guidance and the interplay with existing regulations. Next slide, please. So at a high level, I really think that REBO's expectations in this guidance mirror what their existing expectations are for licensees more broadly. And those are in the areas primarily of competence, integrity, conflict management, privacy protection, and confidentiality. So the use of a new AI tool should not compromise your ability as a broker to deliver on these expectations. It should ideally augment it, but as I said earlier, there are additional risks that are going to come into play when you onboard any of these tools. As a general takeaway, the guidance is fairly short and it's not prescriptive. And I think that that is actually beneficial because the objective in my mind was for the brokers to ensure that they could still embrace innovation and technology and try to get things to their customers in a clearer and more comprehensive and faster manner over time, while ensuring that client rights are protected and that customers are still treated fairly. So with that context in mind, I will pass the mic to my colleague, Jamie, who is very well versed in all things AI and privacy.
Great, thanks, Marisa. We can go to the next slide, please. Okay, so I'm going to begin by discussing REBO's recently published results from its exploration of AI use by Ontario's P&C brokers, and then I'll get into those recommendations that Marisa noted about the responsible use of AI in practice. So REBO, as Marisa mentioned, conducted this study, and the purpose was really to explore key trends in the current and anticipated uses of artificial intelligence by insurance brokers in Ontario, with the hopes of better understanding whether the existing regulatory frameworks adequately address the regulatory challenges that come with these new and emerging technologies. So to do so, a research team reviewed reports and articles from regulators, academics, and industry participants, and conducted interviews with 4 Canadian brokers over the course of about 6 weeks. So this is by no means like a comprehensive study, but it does provide a reasonable snapshot of what's going on right now and where things are likely heading in the industry. Next slide, please. With respect to REBO's findings, the research team found that currently insurance brokers are mainly using artificial intelligence for back office functions. So this would include things like data management and automating routine tasks such as renewals and documentation. And while not yet common, they also observed an increasing use of AI for things like marketing and social media engagement. So this could include, again, just for example, using ChatGPT or a similar generative AI service provider to draft a marketing strategy and to propose LinkedIn content that can be used in alignment with that strategy. REBO noted that because AI use is still rather limited, brokers are obtaining their AI tools from third-party vendors rather than developing any solutions in-house. And this makes complete sense. Like the resources required to develop an in-house model are extreme. So contracting with third-party suppliers is the obvious choice here. And REBO also found that brokers appear to be hesitant about any further AI adoption. And they cited concerns such as undermining the broker-customer relationship, which they viewed as being really central to a broker's value proposition, as well as high upfront costs, challenges in updating legacy systems, and limited technological knowledge and capabilities. Now, just interestingly, as a point of contrast, it's been observed that there's much more robust uptake of AI by insurers who are using these tools for things like risk modeling, fraud detection, claims management, customer service, etc. Next slide, please. Next, REBO made some findings about both the benefits and risks that are posed by brokers' adoption of AI. So in terms of benefits, it's everything you might expect. There's improved customer service. So we may see more accuracy in pricing, more tailored product, reduction in risk, etc. It also offers increased efficiencies and the potential for increased profitability for brokers, as well as expanded business opportunities, for example, by identifying new customer segments and enhanced fraud detection. And this is just because AI's pattern recognition capabilities are far superior, especially as compared to like humans, when it comes to detecting fraudulent claims. In terms of the risks cited by REBO, all of the risks were either assigned a moderate or high risk rating. So these are all things to be live to when adopting AI in practice. The first was the risk of biased or inaccurate AI-generated outputs. And these can arise, just for example, if an AI model is trained based on biased or inaccurate data. So if historical inequalities are used in the training data set, and that is how an AI model has been developed, then it's very likely to perpetuate those inequalities as it's used in practice. And similarly, aside from just training data, AI models learn as they go. So it's possible for bias to be introduced along the way as well. There's also the risk of ill-suited advice on products being delivered to customers. So REBO really stressed that brokers need to be cautious about whose interests an AI model is developed to advance. So, for example, has it been trained to maximize broker fees and broker profits over making recommendations that may be in the best interest of a customer? Another risk was the risk of unauthorized uses of confidential or personal information. So, for example, these AI tools may collect and process personal information in a way that's not permitted or that's not aligned with consents that have been obtained from customers, and that would run the risk of putting the broker offside of their privacy law obligations. And finally, REBO identified risks regarding transparency and explainability. And I mean, this is fair. Like brokers are experts in insurance products. They're not experts. They're not technical experts who can be expected to understand the complex nature of how these AI tools operate. So there's the risk that brokers won't be able to fully explain their decisions or their recommendations if they're leaning heavily on outputs that have been generated by AI. And there's the concern that this could undermine brokers' professional responsibility obligations. Next slide, please. So overall, REBO concluded that there are no regulatory barriers to AI adoption. So the Registered Insurance Brokers Act, bylaws, regulations, and guidelines don't limit brokers from adopting AI. And also, for the most part, the consumer risks associated with AI are largely addressed by the broader regulatory framework that already exists and that already applies to brokers. So, for example, many of the risks that I discussed on that previous slide are contemplated in the RIB Act and the Code of Conduct, which requires brokers to, for example, be competent and honest and act in a client's best interests, to protect clients' privacy and to maintain client confidentiality. That said, there are some areas or risks that are not currently addressed by the existing regulatory framework. So those would include things like disclosure requirements where AI is involved, and the rights of customers to request clarification or an explanation of decisions that are rendered based on AI outputs. So based on the study team's observations, some go-forward recommendations were proposed for REBO to consider or act upon in future. The first was to consider whether there needs to be legislative, regulatory, or guidance-based updates to clarify who is responsible for code of conduct violations that result from the use of third-party AI tools and what the associated penalties should be. Another recommendation was to consider how to interpret and extend the requirements from the code of conduct to AI tools that brokers are using. So as I mentioned, while brokers can't be expected to understand the technicalities and the ins and outs of how these models are operating, they should nonetheless be accountable for the tools that they choose to implement. Another recommendation was for REBO to develop some AI training for brokers. And the last was to develop governance policies on how to responsibly use AI. And this one REBO has actually already acted on, and I'll discuss that next. Next slide, please. Okay, so this past May, REBO issued a regulatory guidance document titled Responsible AI Use Among REBO Licensees, which, as you've probably guessed, explains REBO's expectations for how brokers can responsibly adopt AI technologies in practice. In the document, REBO stresses the importance of adopting an AI governance policy before introducing AI tools, just to ensure that you've got a proper foundation upon which to be innovating with AI. And REBO put forth the following 4 recommendations to consider when adopting or when implementing such a policy. So competency and accountability is the first. Acting in the client's best interests is the second recommendation. Maintaining a human in the loop and being transparent about your AI use was the third. And the last one was about protecting consumer privacy and maintaining confidentiality. And as Marisa mentioned, these recommendations were all pretty brief. There's not a lot of meat here. So I'll discuss them to the extent that REBO did, and then I'm also going to provide a little bit of color with some practical tips that I've come up with on my own, just to sort of like illuminate how these might actually be applied in practice, because again, REBO's comments were quite brief. Next slide, please. Okay, so REBO does not expect brokers to become AI experts, but they are expected to know and understand when AI is being used and to understand the risks that AI poses within their business. Further, it's the broker's responsibility, ultimately, to be responsible with the REBO Code of Conduct. So this applies even when a broker is relying, perhaps quite heavily, on an AI tool that's being provided by a third-party vendor to support their services. So at the end of the day, the buck stops with the broker. So a little practical tip in terms of how you can actually incorporate this recommendation into an AI governance policy is to include processes for ongoing risk management. This would start before even onboarding an AI tool and to continue throughout the life of that engagement. Some other recommendations would be to incorporate staff training requirements related to any AI-based tools or systems that are being used within your organization, to ensure that your licensees are attaining that basic level of competency with respect to how AI is being used. Next slide, please. When it comes to acting in clients' best interests, what we're often concerned about is the risk of bias or inaccuracies in AI outputs, as well as verifying the goals that the AI model is intended to achieve. So when developing your AI governance policy, you should consider requiring a vendor risk assessment, whereby AI vendors are asked about the objectives that their model is trained to achieve. And again, that example I flagged earlier is where an AI model is trained to maximize broker profits at potentially the expense of customers' best interests. Additionally, we recommend that a policy require regular testing or audits of AI-generated outputs to confirm that those recommendations are aligned with customer needs as that model, again, because they learn and they adapt as they are used. So as that model continues to adapt, just confirming that the outputs are still valid and accurate. Next slide, please. So the term human in the loop really just means that there should be human oversight of processes that involve AI. So in this context, REBO is recommending that the use of AI, and in particular generative AI, by brokerages be closely monitored and overseen by one or more licensed brokers, and that licensees be made available to respond to questions and to step in to make corrections as necessary. And I've included a note about liability on this slide. This was flagged in REBO's study, and it pertains to really, like, at the end of the day, who should be responsible when incorrect information, which has been generated by an AI tool, has been provided to a customer, and the customer relies on that information to make decisions. So we don't have REBO's answer to this question yet, but if I was to wager a guess based on existing case law, albeit not from the insurance context, but I'm sure same principles would apply, I would say that the liability would rest with brokers here. So including a human in the loop to verify AI-generated outputs is not only a best practice for responsible use, but it's also a significant risk mitigation measure. Okay, in terms of a practical tip, your AI governance policy should not only require, like as a baseline, that a human be in the loop, but also go above and beyond that just a little bit and ensure that the licensee is sufficiently knowledgeable in the area that they're overseeing. And I'd say this is particularly important because anyone who's used a generative AI tool appreciates that the outputs are convincing, and humans are increasingly showing a bias whereby we tend to blindly believe what a generative AI tool is telling us. And we do so unless we're sufficiently knowledgeable to actually spot the often subtle inconsistencies, inaccuracies, omissions, etc. So that's a little tip for a human in the loop. Next slide, please. As noted earlier, this was one of the issues, transparent use of AI, that's not currently addressed in the existing regulatory framework. So REBO is recommending that responsible AI use requires brokers to be transparent about their use of AI in customer-facing interfaces in particular. So that would include things like chatbots or online quote generators. Basically, customers need to be informed if they're engaging with AI instead of a human. So a practical tip in this regard is requiring that disclaimers be employed when customers are interacting directly with AI. And to go a little bit above and beyond what REBO has recommended, I'd say to also give customers the ability to opt out of those AI-based interactions by electing to deal with a human representative instead. Okay, next slide. This is my last point, so I'll wrap things up quickly so we can get to questions. With respect to privacy and confidentiality, privacy laws dictate how consumers' personal information can be collected, used, and disclosed, and requires that such information be protected. And these obligations extend to any processing of personal information that's happening via an AI tool. So in terms of a practical tip for your governance policy, just extend any privacy-specific policies and procedures that you have to the use of AI as well. So for example, you probably have like a third-party vendor assessment process that you use, and through which you conduct your due diligence, understand the extent to which they're processing personal information on your behalf, confirm that that processing aligns with your own privacy obligations under laws, and then you'd enter into a written agreement with the service provider in which representations and warranties are obtained regarding the same. So same would apply with respect to an AI vendor. And lastly, another example is having a policy around AI risk awareness and prevention. So such a policy could outline authorized and unauthorized uses of AI and discuss prohibited processing of client information by AI. And having something like this that's easily accessible to your staff can really help mitigate the risks of a privacy breach resulting from their AI use. Okay, that's all for me. Marisa, back to you for questions.
Thanks so much, Jamie. Okay, so I'm going to try and get through all of these. So there was a question about adjusting claims for Alberta purposes. So there is an exemption in the legislation. Obviously, you can adjust claims if you have a license to do so, or a certificate of authority that is valid and subsisting. But there's also a provision in the Act for an insurance agent who holds an authority for the class of insurance under that contract. So if you are dealing with a motor vehicle dealership loyalty program, for instance, that is viewed as property insurance, but there's a specific restricted agent of authority certificate for that. That is not a good example because it is restricted and this doesn't apply to that exemption. But the exemption generally says if you have authority for that class of insurance and you're the business that sold that contract of insurance, you can adjust a claim under that contract, but it has to be less than $15,000. That's the prescribed amount currently in the regulation. So that might be a good example for a fully licensed insurance agent who's involved in the distribution chain. Unfortunately, because that exemption is not related to restricted insurance agents, a dealership who holds a restricted insurance agent could not be involved in the adjustment of the claim. And this would be there was some clarification requested around whether it would be for Alberta policyholders only. It would be with respect to an Alberta insurance product. So typically, yes, it would relate to Alberta policyholders, but depending on the facts and circumstances, that may change depending on how, like if it's a commercial arrangement, for instance, and there's multiple provinces involved. So I think that answers that question. And then there was another question about which regulator has shown the most appetite towards pursuing punitive enforcement action, like administrative monetary penalties. I would say generally we have seen most regulators becoming more active and more likely to enforce and to issue AMPs. They don't always issue AMPs in every circumstance because there are always mitigating factors, and every circumstance is different. And it's not, I wouldn't say that it is the norm to go right to the maximum of the AMP, but it is certainly within their discretion if it's in the legislation for them to do so. So thank you so much for joining us today. I really hope you found the session valuable. We will be distributing the slides after the event. So please don't hesitate to reach out to any of our wonderful speakers if you have any questions. And thanks so much. Take care.